Hi, Gabe Francine here with Strategic Financial Group. I want to share with you the most recent market commentary from Mark Sorensen, our Chief Investment Officer, which he released yesterday. Please take a look at this video. I hope you find it informational.
Hi everyone, Mark Sorensen, Chief Executive Officer at Royal Fund Management. It's April 15th, 2025. Oh, that's tax day. But also we're going to record our quarterly market commentary video. The last recording we put out was January 28th, and a lot has happened since then. So I want to review a little bit about what we said then, and then talk about what's been happening lately and what we think will happen the balance of the year. On January 28th, we said, look, we came off a couple of years where the S&P 500, the broad market index, was up over 20% a year, and that we anticipated that we were still in an overall bull market that could last for quite some time, but that the third year, after you've gone up so much 2 years in a row, is often a transition year. In fact, we said at that time that we expected more volatility. In fact, we said we expected the market to be quite choppy. However, we did expect as we enter the second half of the year that the market would still do fine, and we still believe that. At that time, we said that the market had been led the last couple of years by just a handful of stocks. They became known as the Magnificent Seven, kind of like the Nifty 50 back in the 1950s, where the broad market didn't do well, but just a few stocks ran the index. And we talked about how the market was now starting to broaden out. However, the market does not go straight up. And we anticipated that every now and then you have to back and fill, you have to have some profit taking, you have to come down a little bit to build a better foundation to be able to sustain the next move up. So the market came off its high just a couple months ago on February 19th. And the first thing I want to point out about that is the fact that the market was at a high on February 19th is proof in and of itself that we always recover from any type of correction, pullback in the market, profit taking, whether it's news-driven, event-driven, geopolitically driven, or what have you. We have always recovered 100% of the time, and we expect we will this time too. However, in the midst of a normal corrective activity in the market, we had the tariffs announcement on April 2nd. The market had pretty much built in that we might get as much as 20% baseline tariffs, and we only got 10. However, the much higher tariffs on many of our trading partners is what spooked the market and caused some to be concerned that it could cause inflation. It could cause maybe even higher interest rates. It could potentially cause a recession, and the recession expectations have gone up a little bit at this point in time. However, the market generally, when it reacts to news, especially an event-driven pullback like this, the pullback is actually resolved in a shorter period of time than an economically driven pullback. Right now, the economy is still doing fine. A little slower, yes, but it's still doing fine. Unemployment rate is hanging in there. Earnings are improving. Corporate margins are doing fine. So we think the economy, the consumer, is still doing well. In fact, we think the economy will still be resilient like it's been for the last 2 or 3 years. That said, what oftentimes happens when you have a news-driven, event-driven pullback in the market or correction in the market, those events become old news pretty quickly. I can remember many, many times where the news was driven by what if Greece goes into default, many, many other things that you might remember in the market that were news-driven. But once that news cycle changes and the market starts to focus on something else, then the tariffs are already built into the market psychology. They know they're there. Companies adapt, and we move forward. So we think this correction will be relatively short-lived. We do think the bottom is probably in. and I'll give some statistics as to why. One, there's something called the relative strength indicator, which is just a percentage measurement of how the market's doing from the standpoint of strength. It got to a low point that was the low of the COVID era, and even going back to the 2007, 2008 bear market. The other thing we're seeing is the number of stocks, or the percentage of stocks that are below their 50-day moving average, is at a level that is typically seen at the bottom of corrections or bear markets, not at the top. Another interesting statistic is the CBOE volatility index. And I don't want to get too complicated here, but a measure of volatility in the market, the higher the number, the more volatile. Historically, an average volatility might be around 16. We actually had a close on the volatility index of over 50, back down to about 30 now, but over 50 recently, which the last time it did that was near the bottom of the pullback in 2020 during the COVID crisis. So we are seeing a lot of indicators that suggest that the market has bottomed. We may have to test it. We may get more volatility. We're not calling bottom today, but we are seeing a lot of evidence that is probably true. Another thing that we're seeing is that there's only been one time in history when you have a major drawdown down on the market and you get a 50% retracement, which means from the bottom, the market, the S&P 500 recovers at least half of that. Right now, we're just a few points away on the S&P 500 from a 50% recovery off the bottom. Historically, there's only been one time that we made a new low after a 50% recovery. Another thing we wanted to talk about is we respect how scary the market can be during times like this. We also understand that we're all human beings, and sometimes the emotions of the time cause us to think with our heart a little bit and not our head. So what we encourage you to do is ignore it if you have to. The market, as I said earlier, has always recovered 100% of the time, and it will this time too. You know, I've been doing this for 43 years, and if I remember right, the Dow Jones Industrial Average, which is currently about 40,600, went through 1,300 in my first year in business 43 years ago. So the market goes up 80% of the time, but sometimes we forget that means it goes down 20% of the time. And you just have to know that in hindsight, that has always been opportunity, not a reason to panic. So where do we go from here? We are seeing good economic indicators. We recently had a durable goods indicator, which is products that people buy that last over a year. Durable goods indicators were strong. Unemployment still, or the employment rate, I should say, still good. The number of jobs being added every month. The other thing, we just saw a producer price index and consumer price index that showed that inflation is under control. In fact, it was a better report showing that inflation is still trending down. There's a lot of concern that the tariffs will cause more inflation. However, even Fed Chair Powell of the Federal Reserve said recently in a speech that even if there's a little inflation caused by tariffs, it'd be a one-time event, and yet overall inflation is likely trending down. All the market needs now is a new focus. There's been a lot of uncertainty. The market goes down simply because it doesn't like uncertainty. It needs clarity to move forward. However, as we move into the second half of the year, there are three things that we think the market will start to focus on that are very, very positive. One is tax reform. Obviously, the House and Senate looking to pass the tax cuts of a few years ago will continue, but there's also expected to be further tax reform. The other thing that we think the market will start to focus on is the fact that the Fed is expected to cut interest rates. There's an 88% chance right now that they're going to cut interest rates in June, and an anticipation that they'll cut interest rates 3 times. The third thing we think the market will focus on is deregulation. And deregulation will cause companies to be able to move product and ideas to the market much more quickly. It'll make them more efficient overall. So we believe that once the market gets more clarity on the current uncertainty and ultimately focuses on tax reform, deregulation, and interest rate cuts, we anticipate that the market could potentially do extremely well in the second half of the year. A reminder that I said on January 28th that this kind of reminds me of the 80s, 90s style bull market where we went up 16 out of 18 years. But if you would have panicked during the 2 years when it went down, you would have missed big moves. So, for example, during that time frame, there was 1 year where the S&P 500 went down 6.5%, and yet the next year it went up 26.3%. The other time the market went down during that 18-year period, it only ended the year down 1.5%, but the next year was up 34%. So as we said, we think this is the transition year. After 2 really good years, you've got to have some backing and filling. You've got to let earnings catch up to where the market has gotten to. And then as earnings continue to grow, the market moves higher from there. Now, a word on the tariffs. I know it's really an uncertain time, and the messaging sometimes is not always clear and or changes from time to time. But the fact is, if we can improve manufacturing in America, it will help the economy, and in particular, the middle class. It's interesting that the reason I believe they're really trying to change the trade with China is that America has 2 times the worldwide consumption of China, and yet we have 50% of the manufacturing capability. So by making the trade on a more level playing field, that could cause a lot of manufacturing to come back to America, which could be a positive going forward. We've come off the bottom pretty sharply. The S&P 500 right now is about 12% off the recent bottom. And that's another thing I wanted to caution you about. If you make emotional decisions during times like this, you often end up with regret and miss a lot of opportunity going forward. The fact is that the average 10% correction in the next 12 months, the market's up about 29%. So the fact is you have to be there when it turns. The market gets so emotional and people throw in the towel, the old saying, baby out with the bathwater, and that causes that really harsh sell-off that oftentimes ends with a V bottom, meaning it recovers very quickly. And we've already seen evidence of that. We've had 2 days in the last couple of weeks where the NASDAQ 100, which is made up of a lot of the large cap technology stocks, went up over 10% during the day. That's oftentimes a reasonable return for a year. In fact, the day that the announcement was that they might, before they actually did, delay tariffs for 90 days and the reciprocal tariffs for 90 days, the NASDAQ 100 rallied 10% in about a half an hour. So you always have to stay engaged with the market. You have to maintain your exposure because you have to be there when it turns. The market turns very quickly once we get clarity on uncertainty, and you don't want to have regret. Most of us on the call here are probably old enough to look back on our lives and know that more often than not, when we make emotional decisions, in hindsight, it is not the best decision. So we encourage you, just look 4, 6 months, a year down the road, and we think like every other bear market correction, especially event-driven corrections like we have now that oftentimes recover more quickly. 100% of the time we recover. So if you can just focus down the calendar out on the calendar 6 months or longer, you'll be fine. Also, a reminder that we're in an industrial revolution. Artificial intelligence is here, and artificial intelligence is causing a lot of capital expenditures by companies, and that not only will the companies that are involved in the making of the chips and the software for artificial intelligence, every company will benefit from artificial intelligence in terms of creating better efficiencies, better earnings. The market only cares about two things over time: earnings and interest rates. Geopolitical events, event-driven policy changes like we have now, even wars might have quick impact to the market in the short term, but over time, the market only cares about earnings and interest rates. Earnings are good, the consumers are hanging in there, the S&P 500 earnings are expected to continue to grow, and interest rates are expected to come down. So that actually sets the stage for the market continuing to be in a bullish phase and will recover fairly quickly. One other point, those of you who are involved in our 401k maneuver services, which is our 401k account management platform, these are times when you should be almost happy the market's down. During your working life, you know the market's going to come back up. So this is an opportunity to buy stocks and at a lower price through what's called dollar cost averaging. I can remember in my own 401k actually liking when the market was in a corrective mode, because I knew I was buying things cheaper, and over my working career, the market would come back. We would even have you consider increasing your deferral percentage at that time if it's something you can do within your budget. So we thank you for your trust and confidence. We think this pause in the market here is fine. In fact, it's probably healthy. Like I said, you sometimes have to build a better foundation so you can better sustain the next move up. We think the market will start to focus on the three real positive events coming in the second half of the year: deregulation, tax reform, and Fed rate cuts. And we think we'll get more and more clarity over time. We think the market is pretty much already priced in the uncertainty about tariffs. It'll continue to be volatile, more volatile than we've seen in a long time. But as I said, every correction, every bear market, every profit-taking time frame in the market, in hindsight, has always been an opportunity rather than a reason to panic. With that, we'll provide more information as necessary. Everybody have a wonderful rest of your day. Bye now.